Hello there, this is David Roche. This is Quantum Strategy, and this is the mini podcast about macro matters. Okay, starting off with the data which has come out, which is really interesting over the last week on two fronts, China and the US, and starting with the US, the jobs data of creating 256,000 jobs compared to forecasts of 160,000. And indeed, if you go to the household survey of jobs, you get a figure in excess of 400,000 creation of jobs. So, I mean, what does this tell you? It tells you that the US economy is really a way and a hack. People are confident. They're happy that President Trump has been elected, and they think their businesses are going to do well, and they feel confident about their jobs. So what that tells me is the US does not need much lower interest rates. In other words, the neutral rate of interest at which the US economy will provide jobs for as many people as really want to work, and where growth will be strong, but inflation will be tamed. That's the neutral rate of interest. It's probably about 4%. So what I would say to you is this. If you have investments which depend upon lower interest rates to make you money, get rid of them. You either want to get into investments which are entirely focused on growth, or you want to get out of longer-term investments altogether. Now, why do I say out of long-term investments altogether? It is because I don't think that the Fed stopping lowering interest rates, which it probably will at around the 3.75–4% level, the neutral rate of interest, is the end of the story. What you are going to see is long-term interest rates, long bond rates continue to rise. And there are a number of reasons for that. Number one is the size of the US budget deficit and the amount of debt which the US is running as sovereign debt as a percentage of GDP, which is now 100%, but which is on a trajectory to reach 140% not so many years down the road. So that is one reason why you're going to see bond vigilantes creep out of the woodwork, and it's going to become an environment in which long-term rates will rise more than short-term rates, which will stabilize and possibly rise in the second half of next year. The other reason is embodied really in the Michigan consumer survey of last week. And that shows that one-year inflation expectations in the US have gone up from 2.8 to 3.3% in a month. That is bad news. The central banks have to manage long-term interest rates. But above all, they have to manage long-term inflation expectations, because if they don't, then inflation will actually follow expectations and move higher. That is another reason why long-term rates in the United States are probably going to go over 5% at the 30-year level. And that means holding those bonds may mean that you have to wait 30 years before you get your money back. But I think that is something to pay attention to in your portfolios. Now, moving on to the second exciting topic, we had Chinese exports, which for December blew out the trade account surplus. The trade account surplus for December was $104.48 billion. And the expectations, again, were only US dollars 100 billion. So well in excess. Exports, and that is interesting, were up 10.7%. And exports to the United States were up 15.6%. Okay. On the other hand, imports only rose 1%, which shows that the domestic economy remains very weak. What do the exports tell us? They tell us that everybody who runs an export company in China is actually beefing up his exports to the United States now before President Trump takes office and raises tariffs. Now, what does that do? That is actually called dragging demand forward, so pulling demand forward. And of course, once the tariffs go on, the exports will fall away because the exports that are needed to feed US consumption or investment will already have been shipped to the United States. So you create a vacuum, rather like a ship moving through the water. In its wake, there is a hollow in the water behind the stern. Well, that's what bringing forward demand actually does to the economy. The hollow, which is created by pulling the demand forward, is actually a fall in demand, which we will experience in the future. And this pulling forward of demand actually applies in China to two other sectors other than exports. One is that the sale of houses, which shows some sign of life, seems to be much more about selling excess inventories from one branch of the government to another, or from one branch of the government to a bank or to a state-owned enterprise. It does not seem to be due to final demand. That means that once the initial stimulus effect of using the money which has been injected into the system to actually reduce the overhang of houses by transferring it from state entity 1 to state entity 2, once that runs out of steam, then demand will fall. And the third area is, of course, consumer durables like electric vehicles, like laptops and watches and rice cookers and all that sort of exciting stuff. And of course, don't forget washing machines and cookers. Those sort of assets in a house, you can renew them, buying a new one for an old one and get a 20% subsidy from the government. That also is pushing demand forward. And I think it is probably going to create that wake effect, that hollow area behind the boat sailing through the sea for Chinese demand going down the road. So I can see that after the tariffs come on, after all the washing machines have been bought, and once the stimulus financing effect on housing demand runs out, then I think probably in the second quarter of next year, we're going to see another slump in Chinese demand. And with that, of course, will go the renminbi, because the renminbi is now, interest rates on the renminbi are now well below the United States. So what will happen, whether you have laws against it or not, or regulations against it or not, is you will get export of capital out of China pushing the renminbi down. And in addition to that factor, driving the renminbi down, it is likely that the Chinese authorities will let the renminbi weaken in order to absorb the effect of tariffs. After all, if you have a tariff of 10% on a good leaving China, but the Chinese renminbi sinks by 10% against the US dollar, if that good is going to the United States, then the 10% increase in the tariffs is offset by the 10% devaluation of the renminbi, and there's no effect whatsoever. And I think the Chinese will use a weaker renminbi to a certain extent. Now, the final rubric I wanted to talk to you about is tanker sanctions. As you know, on the 10th of January, the United States has imposed wide-ranging sanctions on the Russian energy sector, and particularly upon the dark fleet, which transports Russian crude oil principally to China and to India. But the sanctions are extremely intricate, and they go behind these ships themselves, which are sanctioned, to the owners and the operators of the ships themselves and to the producers of energy. Now, I've done the sums over the weekend, and I'm not saying the sums are right, but they're probably as right as anyone else's. The effect of the sanctions is actually to make transporting oil on these crude oil, on these tankers almost impossible. And what that means is that you are removing a slice of supply to the global oil market, because the means of getting it there aren't there anymore. Now, that slice is equal to between 1.5% and 2.5% of total global oil consumption per day. That of itself is not enough to create an outright energy crisis or shortage, because what actually happens, what is happening, is that demand is quite weak in China and Asia in general. So there is surplus oil around, but what this does is take that surplus oil away. Now, if President Trump comes in and imposes sanctions and embargoes on Iranian oil production, which is probably another 1.5%, 1.5 million barrels a day taken out of the system, then the effect of that will be to create a 5% shortfall in supply relative to what it has been running at in the last 6 to 12 months. That would be a factor in raising oil prices. So it is not that this is the greatest shock in the world. It is that you are moving towards a position where Russian shadow fleet transport of oil to the oil markets is not going to work anymore. That cuts 1.5 to 2.5% off global supply. And in addition to that, if Donald Trump comes in and wallops Iran, as I think he probably will, then there will be maybe another 1.5 million barrels of oil per day taken out of the system. And that would move the price of oil, which I will call the Brent crude price of a little over $80 today, probably up towards $90. And that of itself, of course, is a factor in inflation forecasts, and that's what central banks are going to do. But it also is something which I would be long oil in order to provide some sort of an insurance policy against all the things which I think are going to go wrong on the macro front this year, and which will mean that the volatility of markets, which has really have really been motoring on in denial of the worsening of the world in macro terms, that volatility will rejoin the uncertainty about macroeconomic and geopolitical outcomes. So oil will be an insurance against that happening, which I think it will. Okay, now the last thing we have to talk about today is what's coming up. Okay, well, we're going to have key US inflation data this week, the CPI on Tuesday and PPI on Wednesday. And we also have the kicking off of the earnings season of US companies reporting. That starts always with the major banks like JP Morgan, Chase, Wells Fargo, Goldman Sachs, and Citigroup. So stand by for their results during the year. During this week, I doubt that they will be very bad, because if anybody can make money out of the sort of environment we're in, I think it is banks. The other area which is going to be reporting is Asia, and China is set to release its usual big raft of economic indicators, which include fourth quarter GDP figures, industrial production, retail sales, and what we're missing, which is supposed to have been released last week, is the TSF, the total social financing figures, so credit, loan data, etc. Meant to come out last Friday, probably didn't. It didn't. That could be because it's too bad to publish without doctoring it. And then, of course, we have a few things coming out in other areas of the world. Japan, the Reuters Tankan Index, and in South Korea, the Bank of Korea's monetary policy decision on Thursday. And then the UK, everybody likes to talk about the UK as if it was a big place when it's actually quite a small place. But we're going to have inflation, monthly GDP, and retail sales. Now, what that's going to tell you is the UK economy is bereft of productivity, no spring in its step, that there is sufficient inflation around for the Bank of England to cut rates slowly, but they will cut rates. But it's not really going to save sterling, where it seems like the US, but the markets have woken up to it earlier, that UK sovereign debt is pretty well out of control, and that the market is beginning to wake up to the fact that it doesn't like it. After many years of slumbering of bond market vigilantes, they are starting to crawl out from under, not the woodwork, but the bushes. And that's it for this week. Talk to you again next week. Have a good week.